PE10 valuations across the world. Not expensive anymore, but not cheap yet either. So what we're looking at here is a chart of PE10, so price versus trailing average 10-year earnings across global equities, and specifically we're looking at the USA in the black line, and the median across 46 countries in the blue line there. And so, one of the most interesting aspects of the past decade has been this divergence in valuations between the US there in the black line and the rest of the world. A big part of that divergence in price or value has been driven by a massive divergence in relative earnings performance, with the US significantly and consistently outperforming the rest of the world in earnings growth. But while the US has outperformed the rest of the world in earnings over the past decade, arguably some of this is already in the price, with regards to this gap here, and then some. And if we look at USP 10 valuations, so again, price divided by trailing 10-year average earnings, are about double that of the rest of the world. And not shown here, but shown elsewhere, is the breadth of overvaluation shows that it is actually quite a widespread issue. So we look at across 47 countries there, and more than 90% of countries are at least 20% cheaper than the US by our calculations. One thing also to note on this too is that such valuation gaps can partially close by the expensive one simply catching down or correcting further and faster than the other, and that seems to be happening to a certain degree as we speak right now. But as things stand, this chart is updated for the latest price action there. US equities are no longer eye-wateringly expensive, but they're still far from levels that you might call cheap in absolute terms. Even the rest of the world still has a ways to go before it hits bargain basement levels, and on both counts, the valuation metrics are still significantly higher than the depths of the March 2020 crash there on both counts there. So it's very much still a bit more work to go to get things onto the cheap side as such, or attractive on valuations. Meanwhile, the macro remains fairly unfriendly. But on that note, if the value side of things is good enough, then it can actually speak louder than the macro. But that's not quite yet. And so when we say macro, we're talking about the economic cycle and interest rates, monetary policy. I talked very much in depth about this the other day in a video about recession watch in 2022. So definitely check that out. But other than that, let's just keep watching these type of charts for clues on the next steps. And, that's about as good excuse as any to keep following our work. So the key point for this chart and the key takeaway here is that we would favour global versus US on relative valuations. And also note that valuations have come down materially, no longer expensive, but still not showing up as compelling cheap just yet.